All right, in today's episode, I'm going to be talking about the top 3 indicators that you should be using if you want consistently profitable entries, high win rates, and avoiding losers. But before we get into the content of the video, as always, I like to share my weekly trading review so that you can see that I am actually trading for myself and so that I'm putting my results out there for you to see. So this week, I made 16 trades. We had a total profit, this is not including losses, of 11.63%. We had total losses of 1.86%, which gives us a net profit of 9.78%. I had a profit factor of 6.27, a win percentage of 87.5%, which equates to a maximum consecutive loss potential of 4.6. The average win was 0.83%. The average loss was 0.93%. The maximum win was 2.18%, and the maximum loss was 1.56%. And using my risk formula, that equates to a 7.88% maximum risk and an expectancy of 0.61% per trade. And all of that gives us a Murphy risk coefficient of 0.07, a Murphy reward coefficient of 689.38, and a Murphy performance vector of 5.63. So a very, very good week for me. Very happy about that. So now that that's all said and done, let's get into the indicators. So the first indicator that we're going to be talking about is the Hull moving average. Now, most people have heard about moving averages. They've heard about weighted moving averages, exponential moving averages. These are the 3 most common that you hear, but not a lot of people actually know about the Hull moving average. Now, the Hull moving average was developed and introduced by Alan Hull, and it focuses on smoothness, efficiency, and lag elimination. However, the complication of the Hull moving average is quite complicated, and to be honest, the calculation doesn't matter for us. What does matter is that it's both fast and it's smooth. With other moving averages, generally you have to compromise between speed and smoothness or eliminating noise. However, with the Hull moving average, you get to have speed and smoothness. Now, it's not perfect. There's no perfect indicator. However, in my testing, I generally find the Hull moving average to be a good option. And I've mentioned qualifiers before. In this instance, I find the Hull moving average to be a very good qualifier. And what that basically means is if the Hull moving average is pointing up, then we're only looking for long positions. And if the Hull moving average is pointing down, then we're only looking for short positions. And so that covers the first indicator. The second indicator is the Bollinger Bands. Now, this is one that is a lot more common, and you've probably heard about it in other videos or articles or whatnot. And it was created in the early 1980s by John Bollinger. And it is primarily used to measure market volatility. If you look at it on a chart, when the bands are very close together, that represents low market volatility. And when the bands expand, then we can see that the market is highly volatile. However, we can also use the Bollinger Bands for identifying areas that are overbought and areas that are oversold. So for example, if we look at the Bollinger Bands and if price comes below the Bollinger Bands outside, then that represents an area that might be oversold and that price might want to come back up inside the Bollinger Bands and move upwards. And then conversely, if price moves up outside of the top Bollinger Band, that might be an area that is overbought and there might be a short-term reversal to the downside. The third indicator, and this one is probably one of the most common, although some people don't use it, and that is simply the volume. And the volume measures how much of a given financial asset has been traded over a specific period of time. And although what I'm about to say is not technically correct or perfect, I like to imagine volume as the number of people in agreement. So for example, if price is moving up and the volume is increasing, that means that more people are entering the market, more shares are being traded, and therefore more people are in agreement that price should be going up. And then conversely, if price is moving up and then volume is dropping, that says that less shares are being traded, less people are entering that long position, and therefore it might hold less weight and the move might not be as strong as if the volume was increasing. And the way that I use volume in my trading is I like to use a moving average of the volume. So what I look for is consistently high or increasing volume as I get a signal from either the Bollinger Bands or the Hull moving average, or both, as I'm about to explain. Now, one more thing about volume is that if you get a buy or a sell signal as the volume is high or increasing, and we can say that more people are in agreement, then that would generally be a stronger signal than if you get a buy or a sell signal and the volume is low or decreasing, because that would indicate that the signal is weaker, less people are in agreement. And if the volume is low and you get a signal to buy, that leaves a lot of room with the volume for a lot of people to come in and disagree. So the chance of price quickly moving against you is higher than if you get that signal when the volume is already high or has increased to high levels. Now, once again, this is not technically correct. Volume does not show the amount of people that are agreeing, but that is one way that I like to think about it. And in my testing, it has worked for me. And now we get to the exciting bit. How do you combine these three indicators to form a very solid plan for getting highly profitable entries, consistent results while avoiding losers? And so what I'm going to give you now is the exact entry criteria using these three indicators. So we said use the Hull moving average as a qualifier. If the Hull moving average points up, we only look for buy signals. If it points down, we only look for sell signals. So here is the long signal or a buy signal. So 1, if the Hull moving average is pointing up, and number 2, the Bollinger Bands are oversold, which means price is below the Bollinger Bands outside, price has closed outside, and the volume is high or increasing, then we can say we may now buy, because all indicators are in agreement and it is more likely to be a good signal than if we had only followed one of these indicators. Now, on the flip side, the sell signal looks like this. Number 1, if the Hull moving average is pointing down and the Bollinger Bands are overbought, which means that price has closed above the top Bollinger Band, and the volume is once again high or increasing, which represents perhaps more traders in agreement, then we can sell. And so that is the entry criteria for going long and for going short using these three indicators. And once again, I just want to stress that you should only take the trade if every indicator is in a line and agreement with each other. If only 2 are saying buy, but one of them is saying don't buy, then don't buy, because you're just hurting yourself by lowering your likelihood of being profitable. And so by using these three indicators in your trading, I hope that leads to higher win rate, better risk reward ratios, better expectancy, and overall better results. And before I finish the video, please don't trade blindly based on any information you hear from me or other people. Please do your own due diligence and work out what works best for you based on your own testing, your own research, and whatnot. So thanks very much for watching the video. Please like it if you liked it, dislike it if you didn't like it, share it with a friend if you think they might find value in it as well. And if you want to get a custom-made TradingView strategy specifically for your goals, then please visit my website, mie.trade, and book a free consultation now.